Intel popped 3.6% today, closing at $129.44. That might sound routine, but in the context of where Intel has been and what it's trying to do, it's worth paying attention to. The broader market wasn't on fire. SPY sat at $739, QQQ at $713, and the VIX was a calm 1838. This wasn't a rising tide day. Intel moved on its own story, and that story is one of the more consequential bets in the semiconductor industry right now. This video is going to break down what's behind the rally, what Intel is actually betting on, and where the real risks live, because there are plenty of them. To understand today's move, you need context. Intel's been fighting a 3-year battle to stay relevant. At the start of 2023, the stock was in the low to mid $20s, a painful place for a company that was once the undisputed king of semiconductors. The core problem was process technology. In chip manufacturing, the ability to shrink transistors faster than your competitors is the whole game. Smaller transistors mean more performance per watt, and whoever leads there charges premium prices and wins the best customers. Intel lost that lead. TSMC pulled ahead. Samsung stayed competitive. Intel's manufacturing fell a full generation behind on critical nodes, and customers, including Apple and, crucially, a generation of AI hardware designers, started routing their most advanced chips to TSMC instead. That's the hole Intel has been digging out of. Here's where things get materially interesting. The CHIPS Act money has started moving. Intel received the first tranche of its federal funding package in March 2026. The total commitment from the Commerce Department, combining grants and loans, exceeds $20 billion. That is not a trivial figure. It's one of the largest industrial policy commitments the U.S. government has made to a single company in modern history. The stated purpose is rebuilding leading-edge domestic semiconductor manufacturing. 2 new fabs in Arizona, a major expansion in Ohio, and a facility in New Mexico. The geopolitical logic is straightforward. The U.S. currently manufactures essentially none of its most advanced chips domestically. Taiwan makes most of them. That's a supply chain vulnerability that both parties in Congress agreed, for once, needed fixing. Now let's talk about the product side, because manufacturing capacity alone doesn't win markets. You need chips people actually want to buy. Intel's AI accelerator answer is Gaudi. Gaudi 3 is the current generation, aimed directly at hyperscaler AI training and inference workloads. The pitch to customers like Meta, Google, and Microsoft is essentially this. NVIDIA's H100s and B200s are in constrained supply and priced at a premium. Gaudi 3 offers competitive performance on certain inference workloads at a lower cost per unit of compute. That's the wedge. The question investors are asking today, and every day, is whether that wedge is real enough to win meaningful design wins at scale. NVIDIA's data center revenue has compounded aggressively over the past 2 fiscal years, building a moat of software compatibility, established workflows, and enterprise trust. Displacing that is genuinely hard, but hard isn't the same as impossible, and any durable Gaudi traction would meaningfully change Intel's earnings trajectory. There's a second revenue stream Intel is building that's structurally different from anything it's done before. Intel Foundry Services, its contract manufacturing arm. The idea is to become a Western alternative to TSMC, to let other chip makers, including potentially some of Intel's own competitors, pay Intel to manufacture their silicon. This is a genuinely different business model. Intel has historically been what the industry calls IDM, integrated device manufacturer, meaning it designs and builds its own chips. Running a foundry for external customers requires a different culture, different customer relationships, and crucially, competitive yields on advanced nodes. Getting external customers to commit to Intel Foundry at scale requires proving that Intel's 18A process node, its most advanced, can deliver on specs reliably. That proof is still accumulating. Early signals have been cautiously encouraging, but TSMC's advanced node market share remains dominant, and foundry wins take years to translate into revenue. Here's the honest risk section, because this channel doesn't do hype. Intel's recovery thesis requires several things to go right simultaneously. First, the new fabs need to ramp on schedule. Semiconductor fab construction has a long history of delays and cost overruns. Second, Gaudi needs design wins at hyperscalers before the next NVIDIA generation resets the performance benchmark again. Third, Intel Foundry needs to attract credible external customers and prove yields. Any one of these slipping materially changes the story. There's also a financial reality. Fab construction is extraordinarily capital intensive. Even with $20 billion in federal support, Intel is carrying significant debt and has had to make hard choices about R&D spend. CEO Pat Gelsinger's restructuring plan was aggressive, executing it while simultaneously competing across CPUs, AI accelerators, and foundry services is an operational challenge that few companies have ever pulled off. The market is giving Intel some credit today. Whether that credit is warranted depends on execution over the next 6 to 12 quarters, not the next 6 weeks. One more layer of context worth adding. Today's move didn't happen in a vacuum of fear. The VIX at 1838 reflects a market that's reasonably calm right now, not complacent, but not panicked. SPY and QQQ have both been grinding higher. That backdrop matters because capital flowing into beaten-down cyclicals with a credible recovery story is a classic mid-cycle behavior. Investors who sat out the deep trough are looking for names with identifiable catalysts and downside that's already been absorbed. Intel at $129 still implies significant skepticism compared to where it would be valued if its AI and foundry bets fully pay off. But it also implies the market has moved well past the capitulation lows. The risk-reward calculus here is not obvious in either direction, which is exactly what makes it an interesting story to watch. So what does the 3.6% pop actually mean? It means investors believe, at least for today, that Intel's roadmap is more credible than it was last week. The CHIPS Act funding is real and dispersing. Gaudi 3 is shipping. Intel Foundry's 18A node is in qualification at potential customers. None of that guarantees success. The semiconductor industry has a graveyard full of companies that had good roadmaps and still lost. But Intel has something most of those companies didn't. It's too strategically important to the US government to be allowed to quietly fail. That's not a business strategy, but it is a floor. The question for the next 2 years is whether Intel can convert federal backing, manufacturing investment, and a genuine AI product into durable earnings growth. Today's close at $129.44 suggests the market is giving them a hearing. Whether they earn it is a story still being written, and we'll be watching the data as it comes in. Thanks for watching the Ticker Daily.